Hello and welcome to CNBC TV 18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. On the show today, we'll connect with Harshvardhan Rungta of Rungta Securities to talk about how you can assess your advisor's performance. And a little later, we'll connect with Vishal Dhawan of Plan Ahead Wealth Advisors to talk about factor allocation and its relevance to investors during volatile markets like this. But first up, the big story from late last night. About 2 weeks after first suspending him, Axis Mutual Fund has terminated the services of Viresh Joshi, who had served as their chief dealer as well as a fund manager for what they call non-compliance. Now, the exact nature of wrongdoing has not been established in their release, but it is understood that SEBI is looped in on the external investigation which is being conducted by AZB and Partners and Alvarez and Marcel, and that further action will follow once SEBI's own probe is complete. There is also another fund manager who's currently under suspension, Deepak Agarwal, but there is no mention of him in last night's press release. Now, from what sources have told us, the charges against the two allegedly include front-running, price rigging and collusion with brokers. But the exact scope of what went wrong at Axis Mutual Fund and for how long can only be established once the final report is submitted. So let me begin the show by asking our first guest about exactly this. Harshvardhan Rungta of Rungta Securities is with us. Harsh, the news that is out now is that one of the two fund managers who was suspended has been, his employment has been terminated. When we first broke the news and we had asked experts for recommendations on what unit holders should do if they're holding Axis schemes, the overall advice from experts was that remain invested until we know more for sure. Now we know a little bit more, and it is pretty damning that the chief dealer and fund manager has been terminated. For what exact reason, we don't know. But what should investors make of this? Is it, should anybody at all be looking at exiting their schemes, or do they remain invested for now?
Very good afternoon, Sumaira. You rightly pointed out that there have been some developments in Axis Mutual Fund as a result of which first there was a suspension, now a termination. So, what an investor needs to understand very clearly is that there has been something going on which is not in compliance with the laws, and there has been some kind of, misdeeds in that sense. You must really understand as an investor how much impact is it going to have on your portfolio. Now, how long are you going to continuously keep removing money from one scheme, going to another one, and then again realizing one is a fund performance, then again something else happening over there. So in my personal opinion, I don't think there has to be any panic in the minds of the investors right now who are unit holders of Axis Mutual Fund particularly, to go ahead and, in panic, just sell off and redeem out of things. I don't think that is required at this juncture. Follow the scheme performance from here on. If you find that the scheme has been, dropping down from its performance level, then probably you take an action, not merely basis of this information.
All right, understood. So basically for now, maintain a status quo. But anyway, today's show, we are going to focus on how to, assess your advisor's performance. So if you have an advisor who's been helping you create your portfolio, how do you know if they are doing a good job? So Harsh, is there any ideal ratio, or, what are the parameters on which investors can judge? Let's begin with returns.
Okay, so Sumaira, if you were to get on to judging your advisor, evaluating the performance of an advisor, I think let's just take one step back and empower the investor to understand, what are the nuances of those returns that we're talking about in your portfolio. So, as and when an investor, say, probably gets onto the field to start shortlisting products to invest her money into, the first, the statistics, or the first, the factor to consider is to make a list, or rather just note down what is the rate of return a risk-free product in the market is offering. So a risk-free product would be, say, a government securities, a post office time deposit, or a fixed deposit kind of product. These are products which do not have capital risk involved in them, and government security is considered to be the safest, have a sovereign backing. So if a rate of return on this risk-free product is, say, 6 to 7%, so as of now, Gilt would be, say, 7% plus. So let's take, for convenience sake, let's take the the figure of 7%. So 7% is the rate of return that an investor currently will get if she takes no capital risk on her investment. Then you look at another product. So now you're comparing this with, say, equities, for example. So then you look at the average return that equities have given in the similar time period. So say, for example, equities have generated a return of say 12%, for example. Now, in this case, the straightforward comparison becomes that product one, which is risk-free, is generating 7%, and equity has possibly given you 12%. So most certainly, this 12% hasn't come without taking any risk. There has to be certain risk that this product is inbuilt with. So it would be, say, the risk of capital erosion. There could be volatility risk. So when you undertake these kind of risks, the market rewards you for taking these risks, and that is why you're earning an extra return. So which is essentially the premium that you get from the market. So in this case, it would be, say, 12% minus the risk-free return, which is 7%. So 5 percentage points extra is what you've earned in lieu of taking those risks. So now, having understood this, when you entrust your money to a fund manager, now you can't merely look at the returns that the scheme has generated and then take a call whether the scheme is doing well. You need to understand what is that risk that the fund manager has taken, and in return of which, what is the higher returns that they have generated. I'll enumerate this with an example. Suppose a fund A has a high risk strategy, so they have a beta of say 1.5, and they have generated a return of 15%. Now, in comparison, there is a fund B, which has a lower risk strategy, which follows the market, has a beta of 1, and they have generated a return of 14%. Now, you will notice with a lower risk incorporated in the portfolio, Fund B has actually given you better returns when compared to Fund A in comparison to the risk that they have taken. So, what is beta? Or in a simple word, it would be the volatility in a portfolio when you compare it to the overall market. So, if you're taking a higher risk, the beta will be higher. If you're taking a low risk, the beta will be low. So, when you compare these factors together, then you will actually see the outperformance. Now, as an investor, when you look at judging returns of a portfolio, how do you judge? So you have to consider, of course, the returns that are being generated in comparison to the risk that the fund is taking. So there are various ratios that an investor can look into. However, if I may just shortlist some quick three easy ratios to follow for investors, it would be one, of course, the first one that you'll have to look at the beta of the portfolio. So as I said, beta is nothing but the volatility in the portfolio when you compare it to the overall market. So a beta in excess of 1 will be considered to be a high risk, it's higher volatility than the overall market. If it's lesser than 1, it will be lesser volatility of the portfolio than as compared to the overall market. So beta is one factor which will give you an assessment of how much risk is being undertaken. The other ratio that an investor can look into is alpha, because that's ultimately the reason why an investor is taking that kind of risk. So alpha is nothing but a summary of all the risk undertaken by the portfolio and the excess return that they've generated over the market returns in your portfolio. So alpha is a straightforward number that goes on to say that, look, hey, I've taken that much risk in the portfolio, but I've generated this much excess return. So that gives you an indication straight away that what is the excess return you're generating. The third that you, as an investor, would want to know, particularly in markets that we are in right now, which are very volatile and on the downward side, you want to entrust your money to somebody whom you believe can, manage the downturn in the market efficiently. So a Sortino ratio will kind of give you an indication how well a fund manager has been able to contain the downside when the markets are falling, how it has managed the downside. So I think, primarily, if you look at just these three, and an investor can kind of get an idea as to what he or she is getting into. Now, when you're creating a portfolio, you need to understand that your risk profile needs to match the risk profile of the portfolio that is being undertaken. So yeah, these would be, I think, just what a layman investor can also kind of get into and try and figure out what is happening with their portfolio. Don't merely look at returns that has been generated. It has no sense by itself. You have to compare it with what the risk the fund is taking.
Yeah, absolutely. And it's not just always all about returns, right? Because an advisor could also be investing in riskier schemes to generate superior returns. So how does an investor know, what is the risk being taken for the return that's being given?
Yeah, absolutely, Sumera. An absolutely relevant question. I'll tell you why. Because, investors tend to be very return centric. I mean, we come up with investors asking us, simply putting up, and looking at past 3 years, 5 years, 7 years or 10 years data, returns rather, not even data, just simply look at the returns that this scheme has, generated over this period. And, and they simply say that this is a scheme that we should be investing into. Well, that's not the right way to go about it, because as I explained, that a scheme would be generating a very high return but it may be undertaking a very high risk, which is not suited to your profile. So what you need to look at, you said, how do you judge your advisor or judging the risk that your advisor is taking? So one, if you know exactly how much risk you would like to take. So somebody may come up and say that I'm comfortable taking risk in line with the market. Basically, they want a portfolio which has a beta of 1, which is in line with the market. Somebody says, no, I want outperformance from the market. I'm willing to take that additional risk. So your portfolio beta should be say 1.5 for that example. Or somebody says, look, I want more than FD. I don't want to take as much risk as the market. So you take a portfolio which is less than 1, which is the beta being less than 1. So you need to, sit down with your advisor and, align your risk and your portfolio along with that. So if your portfolio has already been constructed by somebody, please look into these kind of data, these kind of ratios, and see whether the risk taken by your advisor is in line with your risk profile and not the risk profile that the advisor is comfortable taking. Because it's not his portfolio, it is your portfolio. The risk profile of that portfolio should be in line with your risk and not that of the risk-taking capacity of your advisor.
Understood. Harshvardhan, thanks very much for joining in. Of course, it's a very interesting topic and, we can go on, but these two important parameters needed to be covered, which is return and risk, and how do you assess it? With that, we're going to take a very quick break. Up next, we'll connect with Vishal Dhawan of Plan Ahead Wealth Advisors to talk about factor allocation and its relevance to investors during volatile markets. Stay tuned.